Good afternoon, and welcome to another Barometer Readings webcast. My name is Pamela Hastings, Relationship Manager at Barometer Capital. And joining me today, as always, is our Chief Investment Strategist and President, David Burrows. On today's webcast, we are pleased to provide you a market update. And as well, we would love to welcome your questions, so don't be shy. Email me at phastings@barometercapital.ca. or hit me up on the Zoom link. And with that, I turn the conversation over to David Burrows. Good afternoon, David.
Hi, Pamela. How are you?
Great. Thanks, Dave. Nice to see you.
Nice to see you, and welcome to everybody who's on the call this week. It's been an interesting week, lots to talk about, so we'll get right to it. Certainly, the last few weeks have been challenging for investors. We've tried to position as best we could going through the last several weeks of decline, and I'm pretty generally pleased with how things have gone. We'll just take things from the top from a macro view. As most people know, we believe we're in a structural bull market for stocks that started in 2013. And while there have been several sharp pullbacks along the way, including the fastest bear market in history in February, March of 2020, market has in general been working its way higher. The declines that we've seen have been much sharper than what you tend to see in a structural bear market, which are longer and more drawn out, like the bear market 2000 through 2003 or 2007 through 2009, or going back to the last structural bear market, 1973-74. But there's always the concern that a shorter term bear market can turn into something more significant. But in general, in a structural bull market, it's a pause to reset, an opportunity for people to take a breath, reestablish their views, examine the world that's going on around them, and make sure that they're positioned for the next leg higher. And we may well be facing that. Here's a more near-term view. This highlighted box is the structural bear market from 2000 through 2013, where the S&P made no progress. Since then, there have been several corrections along the way, each of them a combination of time correction and price. This is the 2020 correction, which was very sharp, yet short. And this is the correction, we've been going through really since the very beginning of the year. Not much different than what we've seen in the structural bull market through the 80s and 90s, very, very similar. And so our base case is we continue to be in a structural bull market. We've been making a case that we went through a generational bottom in interest rates in 2020 at the worst point of the pandemic. And since then, we have been seeing rates work their way higher. We know the last time rates bottomed in the late 1940s, early 1950s, you did get inflation in bouts, but they were more cyclical, but slowly rates rose over time. So there was a bump up in inflation in 1951, 52 at the beginning of the last structural bull market that was coming out of the Second World War, and a big push in demand and not enough supply. Supply response came in, and ultimately, slowly the economy improved. And so that really is our base case, that this correction we've been going through is recognizing the fact that we've had a sharp increase in interest rates. That's thrown a lot of investors off balance. We certainly have had a pickup in inflation. Some of it may be sticky, some of it may be transitory. As supply comes back online, we note that China really appears to be opening right back up again. And we'll soon be seeing some more supplies coming from overseas. When we look at the 10-year yields we talked about over the last few weeks, we had reached our sort of initial objective. Rates had gone from 45 basis points through 3%. We sit now around 3% and around the long-term downward moving average. We think that probably it needs to consolidate here for a little bit. And we think that's reasonable given the fact that I think views about economic growth are sort of a battleground. Some people believe we could see a recession. Some people believe it's simply a slowdown. The market will tell us that ultimately. But in the near term, probably rates have, for the most part, run their course. The pullback in the TLT ETF was 37% from top to bottom. It reached the long-term upward sloping moving average. And again, probably a place to consolidate. So for that reason, we took off all of our shorts in the bond market about a month ago, and really have only a very small short position just reestablished over the last couple of days. When we look at commodities, we think that commodities have been going through a secular shift and that after many, many years, going back to the early 2000s, significant underperformance versus equities, we've seen a turn higher in relative performance. And certainly it's been a sharp move off the bottom. When we go back to the spring of 2020, the RJI index was sitting down here at $3.25, sitting today almost $10. So it's been almost a triple in an equally weighted basket of commodity prices. We all see it. We all go to the gas station, or most do. People buy things in the grocery store, whether it's agricultural commodities or hard commodities, prices have been marching higher. And that's been an important investment bucket for us to focus in, because in inflation, we want to own things that benefit from inflation, the price setters. And a lot of the companies that produce these commodities have done quite well. There's the RJI index in a shorter term, from a shorter term perspective. In fact, just today, we made a new all-time high. We pulled back a little off that later in the day, but certainly has acted really, really well relative to other investable assets. And this has been an important place to hide out through what has been a difficult recent stock market. When we look at equities as a whole, the value camp has been a good one to be in. This is the pure value ETF, the relative strength rising versus the S&P 500. This tends to be companies that are a little bit more economically sensitive, a little shorter term duration companies. So let's talk about stocks as a whole. Last week, we said we may be hitting a point where we could get at least some short-term relief. Some of the data on the Nasdaq were getting to extremes, and some of the data in the breadth had been improving over the last few weeks. And we'll touch on that today. But certainly we got a very sharp rally in the middle to the end of last week, after last week's call. And three important things happened. 3 consecutive days where upside volume exceeded downside volume. In other words, people reaching up to be buyers on a broad majority of stocks. In fact, on Wednesday, Thursday, and Friday, 80% of issues in the market were up on the day. So an 80% up day once is good. 80% up day 3 days in a row has tended to coincide with even longer term bottoms in the market. So we won't know for some time, but certainly that was a sharp improvement and one that we think is warranted given what we were seeing from some of our breadth models. When we look at the Nasdaq, we talked about the fact the Nasdaq had come down to an upward sloping 150-week moving average, where often this had marked a short-term low. Also, that it was extremely oversold. In fact, the lowest stochastic reading since in the last 20 years. We also talked that relative to the S&P, it had underperformed very substantially, and to the point where, in most cases, you got at least some relief from that underperformance. Now, as I say, we don't make decisions based on that. We need to see the rubber hit the road. And again, we have seen 3 very good up days to end the week last week. And today, I think as I turned on the webcast, Nasdaq 100 is up about 0.5%. So there's lots and lots of work to do here. Lots of resistance above us. Lots of sellers who are underwater. So we don't think this is a straight up move, but we do think probably there are some legs to this rally, and there may be some opportunity to be had both by those who are underwater on positions and maybe to add a little bit of exposure given the fact that it has been such a difficult place to be. Nasdaq 100 was down 31% at the lows over just about 5 months. So TSX has been an outperformer all through the year, actually just about break even on the year. So in fact, this has been one of the best markets in the world, and it also had a very good week last week. Now, we follow price action. We follow whether assets are strengthening or weakening versus other assets, like commodities strengthening versus the S&P 500, which gives us a sense we should maybe overweight that area a little bit. But most importantly, we assess the health of a particular asset class or sector or theme by whether, in fact, breadth, or the percentage of stocks in uptrends, is expanding, That's healthy when more and more stocks participate in a rally, or whether over time breadth is contracting, meaning fewer and fewer securities within a group are behaving constructively. So when we see deterioration in breadth, we reduce our exposure. We don't put any new positions on. If we wind up getting stopped out of existing positions, the cash stays on the sidelines until we have an alternative opportunity or we start to see improvement. So just quickly going through the last few weeks, on May the 10th, all of our long-term indicators and short-term indicators for equities globally were negative. And we know we were in a broad-based decline. On May the 17th, we started to see some improvement in our short-term indicators, predominantly in the US. The following week, we had the majority of our short-term indicators positive, and global equity breadth started to improve. And then last week, leading up to today, virtually all of our indicators turned positive, save one in the Canadian market. So we don't know how long this goes on for, but we do know that we got to exceedingly oversold levels, at least setting up the opportunity for a summer rally. And it may well be that the things that have spooked the market, the Fed's hawkish posture or slowing economic data, could cause another bout of selling later in the summer and into fall, which often happens. But as it stands right now, it looks as though there may be a more significant opportunity in the near term to catch a bounce. So as you know, many of our positions actually held up quite well through the course of the decline. The question is, where does the leadership come from now? When we looked at May 17th, the average country had 31% of stocks in uptrends. The first two markets to turn positive from a breadth perspective, interestingly, were the first two markets, Hong Kong and China mainland, that turned down into this correction. We fast forward a week to May 24th. We'd gone from 30% of stocks in uptrends globally to 33%, and more countries turning green. When we sit and look at it today, 37% of stocks globally are in uptrends. And we can see that many regions within the world are turning green. So breadth is an expanding number of securities, or an expanding number of countries, or an expanding number of asset classes performing well. And we are seeing that from the equity asset class, not just the US, Asia, many European countries, and some emerging markets. Let's go back and talk about leadership, where we're focusing. Are they continuing to work? Is there other leadership emerging? Because the big question will be, on a rally, where is there opportunity? And where may we just be seeing short covering? So for those that have been following along, the energy index has been the one that we've been most interested in. As oil and gas prices have been going higher, after a 70% bear market in equity prices in the energy sector, we've seen a very sharp rally since 2020. And that has been continuing. As of today, the XEG index, which is the Canadian TSX Capped Energy Index, made a new high, as did the XOP, which is the ETF holding exploration and production companies in the US, as did the XLE, which is the broad-based energy ETF, the largest in the US. Trading better than 97% of all the equities in the S&P 500 in the past week made a new relative high and continues to behave very constructively on the back of stronger oil prices. Frankly, the target that we see for oil is substantially higher than where it is now. I don't want to quantify it, but it would not surprise us to see $135 or $140 oil, but certainly it could pull back. We are stretched away from the 50-day moving average. A few days of pullback probably would be healthy. But we do know that since about the beginning of 2021, on a relative basis, gas-producing equities, natural gas-producing equities in Canada have been strongly outperforming the S&P TSX. And the S&P TSX actually has been performing quite well versus the S&P 500 over the last year. So this continues to be leadership in the market. No evidence of a reversal here. Certainly stretched and could pull back, but really the targets look significantly higher. Materials, basic materials, commodities producers, companies that produce the materials where the commodities where the prices are going higher. This is the FXZ. It's made up of companies like Rio Tinto and Nutrien and Freeport and Archer Daniel Midland, and some of the steel companies and some of the chemical companies. Again, price setters pulled back only 11% during the correction, which is about the best performing sector outside of energy. Very quick to move back to highs, made a new relative high versus the market on Tuesday of this week. Sorry, that's this morning. Friday of last week. And again, continues to be leadership. So energy and materials continue to lead. Certainly, they could have a pause if we get a significant bounce in some of the underperforming groups. We'll look at those, but they continue to be leadership, continue to be an important source of opportunity, we think, in our portfolios. Let's go to some specific groups. This is the miners. We talked about the fact that we had pulled back to the rising moving averages. We got a very nice rally last week. We pulled back a little bit today, about half of what they gained over the course of last week. But remember, they're coming out of a bear market that they've been in since 2014. They consolidated, blasted off, pulled back to a higher low. Again, we think that there's room, a lot of room higher for metals producers. This is the agricultural producers, Archer Daniel Midlands, Nutrien, and so on. Again, pulled back to the moving averages, remained very constructive and turned higher. So I think it's safe to say in those two key groups, leadership remains. There is a basket of dividend payers from the same category: BHP, Nutrien, ExxonMobil, Chevron, Vale, Anglo American. Again, working their way higher from a relative strength perspective. Underperformed a little bit over the last week, but certainly continue to be strong. Dividend theme has been another key theme for us, especially dividend growth stocks. This is the FDL ETF, Morningstar Dividend Leaders. Look at that, made new all-time highs on Friday. Pretty strong versus a Nasdaq down 30% or an S&P 500 down just over 20%. Now, of course, it rallied last week, not quite as sharply as some of the Nasdaq stocks did. But again, we'll look at whether in fact something significant has changed there or not. But leadership remains in the dividend theme. Within the dividend theme, we see leadership coming from global infrastructure companies. Again, very close to all-time highs on Friday. The energy infrastructure companies, the MLPs in the US, the pipelines and so on, nice rising relative strength. And the utilities. So all of the key dividend paying groups, and especially those with some inflation protection by way of energy exposure, et cetera, continuing to perform well. So let's look at some of the groups that have been underperforming. They certainly had a nice bounce last week, but let's talk about them. The XLK is the select sector spider for technology. It's had a very difficult start to the year, a series of failed rallies. And again, here we go. We've rallied sharply into declining moving averages. Now, it may well be that there is room to the upside here, but there is nothing at this point that really would say we've had a significant reversal. This is relative strength versus the S&P. We've had a few bumps along the way, but continues to be in a downtrend. Let's go beyond technology. This is the consumer. Again, a very sharp bounce over the last week into declining moving averages. We've had a number of pop higher in relative strength, but we must say that relative to the rest of the market, the consumer discretionary sector has underperformed now going back to early spring 2021. That may well continue to be the case. We'll see whether something develops from here. Industrials. Now, industrials have behaved a little bit better than discretionary and technology. You can see basically relative performance has been about flat. Actually, if we were just to focus on the defense stocks, which we've talked about over the last few weeks, the picture would not be as pretty. But certainly with the defense stocks, they performed well in the group for obvious reasons and probably have pretty good legs in front of them. Communications, a sharp bounce, not much more to write about, into declining moving averages, a declining relative strength line, and healthcare. Now, healthcare has acted better for sure. The pharmaceutical group really within healthcare has been the place to be. We do have some pharmaceutical exposure. They tend to be large dividend payers, and we'll talk a little bit about that in a moment. There's the Pharmaceutical ETF. You can see trading above rising long-term moving averages. So these would be companies like Eli Lilly and Bristol Myers and Pfizer, Merck, and so on. For obvious reasons, these companies have done better. The one area that does look like it's showing some improvement under the surface is financials. And this is an important one. I think it's important for a couple of reasons. First of all, if the belief is that we're headed into a recession, then this is a sector that you would expect to behave very poorly. Now, top to bottom, it sold off about 20.5%. This is the XLF, or the broadly based financials ETF. Well, 20.5% is virtually identical to the sell-off in the S&P 500. So you can see relative to the rest of the market, basically has been in line. If we pick this apart, there are a couple of groups within financials that have acted better. We know that digital payments behaved poorly. On the other side, insurance has had strong relative performance, really going back to the beginning of the year. So first of all, of the sectors that have been out of favor, financials are actually showing the best relative performance outside of our key groups. Insurance companies are outperforming almost every other sector. This would include companies like Allegheny and Marsh McLennan, Principal Financial, Allstate. But this is a group that's quite interesting, and a group that we have some exposure to, but have been increasing our exposure. So let's just recap. At the worst point in early May, almost all of the sectors that we follow from a breadth perspective were in small letters, meaning breadth was deteriorating. The average sector had only 20% of stocks in uptrends, and many of them fewer than 15%. When we fast forward to the 23rd of May, we saw a number of sectors. We're starting to see improvement in breadth. In other words, had seen breadth turn positive. We're now in capital letters, including some groups in broadly underperforming sectors like semiconductors within technology started to show improvement. If we look at it today, as of the 27th of May, the end of last week, we can see that virtually all of the sectors have turned positive. We now have the average sector has 34% of stocks in uptrends. There's some obvious outliers like oil and oil service, utilities. Semiconductors have moved up nicely. Insurance, which we just talked about, moved up nicely. But we've seen improvement in things like banks and transports, economically sensitive groups that you would expect to behave very poorly if you think that we're headed into recession. Now, the fact is, we talked about the fact that in secular bull markets, recessions tend to be discounted after the market has pulled back roughly 20%, which is about what we've seen. So we don't know whether we've entered into something that is a longer term rally back towards highs and then on to new highs, or whether we're headed into summer rally that may well only last a few weeks until we test it again in the fall. But in the near term, we take action based on these breadth models. And our job is to recognize change. Our job is to focus our portfolios in areas of leadership. Well, it's tended to be, over the last few months, we've been mostly focused in basic materials and energy, with a secondary focus on strong, defensive, dividend-paying stocks. We look for signs of new leadership. So we've seen some improvement in financials. We've seen some improvement in industrials. These are areas that we can focus on, perhaps to take new positions. And if there was no leadership, as there wasn't for a few weeks, we sit on some cash. So here's how we stand today. Energy continues to be by far our largest weight in portfolios at roughly 33%. Now that's a very significant weight relative to the rest of the market. But strategically, it's a very important asset. And realistically, there is going to be disruption for the foreseeable future. When we look at the number of new wells that are being drilled, it's not ramping nearly as quickly as one would have expected, given the fact that boards have committed to raising dividends and buying back shares instead of putting money back into the ground. We know that the average well being drilled is less productive than the wells that were drilled 3, 5, and 7 years ago. And we know that geographically, the geopolitical picture is not good. And it looks as though it's going to be very difficult to add new production outside of Canada and the US. We also know that natural gas is being liquefied, and the trend is to send US natural gas to supplement gas in Europe and other parts of the world. So we think it's an important asset and continue to be revalued. If oil were to go to $140 or $150 a barrel, which is not outside of the realm of possibility, the equities would probably be twice as high as they are now. The other area we've added over the course of the last week is financials. We've taken our weight up to 8% from 3%. And then the other area that we added a little bit to was industrials. So we're adding dividends, we're adding financials, we're adding a little more in energy. We're not chasing sectors that at this point look as though they may be short-term bounces. And then we look outside of the US. We've seen rising relative price strength for European equities that are hedged back to US dollars. They actually made their low in the early March, a higher low when the S&P was making its low in April, a higher low when it made the S&P made its low in May, and has made its first higher high. That is valuable for us to add small weight. Japan has been relatively outperforming. They've been trying to create inflation for the last 25 years. Mexico, which is largely driven by basic materials and energy, making relative strength gains versus the US. And actually, for the first time in a long time, some of the Chinese equities is looking interesting. As they reopen, some of the groups that have been badly hurt by the slowdown in China and the crackdown by the Chinese officials on technology look as though they're trying to make a turn. This is the KWEB. It's the China Internet Sector ETF, which include companies like Baidu. It sold off 80% from the highs over 280 days. It made its first low in early March, a higher low in April, and is now making its first higher high. Now, we don't know whether this is something that can carry on, but this is an important part of the world, and we have a very small exposure in our macro portfolio. Within technology, the one group that held up better than the rest was semiconductors. This is the long-term chart. This is the 150-week moving average. It turned nicely off it. We built a small position here. That's inflation protected because they can raise price as demand is strong. And we put a very small position on in the software sector. This is the IGV ETF. So the macro portfolio is not supposed to be a North American equities portfolio. It's a multi-asset portfolio that's long short, that can go anywhere in the world in any asset class. In an inflationary world, it's an important hedge across our client portfolios. So outside of energy and materials and dividend paying equities and agriculture, we have newer positions in US small cap stocks, emerging market equities in European developed markets, a small weight in industrials, a small weight in Japan, a new weight in financials, and a new weight in China. Healthcare is the Pharmaceuticals ETF, and technology is just really the Semiconductor Sector ETF. So we'll see whether this turns into something or not. But you can only do this step by step, as we said last week. As the data supports it, we build new positions. Now, we highlighted 3 weeks ago that in a secular bull market, I highlighted the recessions that happened during secular bear markets. It tended to be that the market pullback was 15 to 20%. So we got 20.5%. We didn't make a decision to put money to work then. We wanted to see breadth start to improve. We know that volatility that spiked in May made lower and lower highs as the market was making lower lows and recently broke down. We never exceeded the first spike in volatility that took place in late January. This tells us that some of the volatility or turbulence in markets is starting to decelerate. Now, it may well be that this is only a bear market rally. So the market was up 9% over the course of the last 5 days. And that's a lot. But relative to other bear market rallies, and if this was a bear market rally, there may well be significant upside still in time or in price. They have tended to last on average about 50 days. And you could see as much as a 25% rally in the market in the offing. Now, we don't know what this might turn into. It may well be a bear market rally. It may well be that we've seen the lows and we go on to make new highs. We can only do step by step. But these can go on a long time and they can move higher, 15% on average over 34 days. So we're going to continue to look at the data. We're going to continue to evaluate the portfolio. We're continue to look for new leadership. And we're going to continue to think about what other risks the market may not be considering. But in the near term, the bull market, the secular bull market in equities looks as though it continues to be alive. The secular bull market in commodities looks well to be alive. And the secular bear market in bonds almost certainly is not over. So we're going to govern ourselves accordingly. If things get worse, we have a habit of getting defensive. And I'm pleased to say that virtually all of our portfolios year to date are now in the positive against a pretty tough market. So with that, Pamela, if there are any questions, maybe we could address them.
Absolutely. Thanks so much, David. First question, David, you mentioned potential for a bounce in the Nasdaq and technology. Can you overlay that view of interest rates to help illustrate that this idea should be considered more of a short-term trade versus a long-term investment opportunity?
Yeah, I would say that we have to look at what's happening in growth stocks over the last week as more likely a shorter-term trade. If rates continue to moderate as they have over the last few weeks, that probably gives opportunity for the assets that got hurt by higher rates to have some relief. And so that's part of the reason we're seeing a rally in tech and a rally in secular growth stocks. If we've seen a generational turn in rates, these rates that we're looking at in 10-year bonds and 5-year bonds are over time likely to go higher. But for a few months, they could be very benign and give an opportunity for some of those most badly beaten up sectors to have a little bit of sunshine. The problem is when a sector has outperformed for a very long time and a lot of investors came late to the party, there's a lot of people who are underwater on their investments. And the way that it works is if you get hurt badly enough, you just can't wait to get close to your break-even point to get your money back. So I think that there are likely quite a few sellers in the weeds waiting for higher prices. Now we're going to have to look at what the news flow is and how that impacts markets. If inflation starts to moderate, that would be helpful. And it may mean a broader cross-section of stocks can perform well, but we may need a little bit more time to see that. The Fed most certainly is going to stay hawkish until they see some of the inflationary data come off the boil. So I think it's a little bit like playing with fire. I think that of the technology groups, Semiconductors, which sell their goods in quick inventory turns and have an ability to raise price regularly, might be one group that could outperform the rest of tech. And that's why I put a small position on in the macro portfolio. But my tendency would be to look for opportunity maybe in financials, which only just last year came out of a bear market they've been in since 2008. There's probably opportunity there. There's probably opportunity in some global markets like Japan that have been fighting disinflation or deflation for 25 or 30 years. And certainly there's going to be some strong stocks within tech that give an opportunity, but I'm not sure it's time to be anywhere near market weight, which is still north of 25% of the index in the S&P.
Thank you, David. Just on that, would you be able to further elaborate what you would consider a high interest rate?
Well, if I bought a house and with an 80% mortgage on it, going from 1.5 to 3 would feel like a high interest rate. The 10-year moved to 3% from 40 basis points. It's not so much that it moved higher, it's more how quickly it happened. What spooked the market over the winter was a very sharp increase in rates. And if you looked at the percentage point increase in rates, it's quite substantial. Very quickly, long-term rates tripled. So I think in the near term, the market probably has discounted the most likely path to higher short-term rates, 3.5%. But we're going to have to continue to assess. I think what I'm talking about when I talk about a secular bull market in rates or a bear market in bonds, I think we could see generally rising rates in fits and starts for the next 15 or 20 years, which is how rates move. And if that's the case, then assets that are helped by falling interest rates could be under pressure for a long time. Bonds from 1951 to 1966 gave a total return of 1.6% a year, and inflation averaged over 2. So they gave a negative return for 15, 16 years. Real estate has been helped by falling rates for 40 years. The average mortgage payment per dollar of mortgage, continued to fall, meaning that people could pay higher and higher prices. I think probably real estate has a headwind for a long period of time. So we want to focus on assets that are short duration assets. In other words, have an ability to raise price frequently if they need to. And it may be that we'll go periods of time where inflation is more benign and we see less of that. But the sectors that were hurt by falling interest rates or hurt by disinflation have become very small parts of the market, and they could slowly become more and more important, which is why we are overweight things like basic materials and energy.
Thank you, David. The next question comes from Eric, who has a 0% weighting in China and is a little concerned about the potential escalating conflict between Taiwan and China. He's asking David if you would consider adding a small position or just sitting on this, or would you recommend he just sits on the sidelines? If you're constructive, he's very curious to know what ETFs you would like in that space.
Look, I mentioned we are seeing some change here. There are major risks. So this is the ASHR ETF. The bear market started back here in late part of 2014-15. We came out of it, but you've had this very sharp deceleration in price, probably largely driven by their COVID response, but also concerns about Taiwan and frankly, the geopolitical relationship that they have with the rest of the world. I think you have to be very careful here. So that's the CSI 300 ETF, the K-Web that I talked about on a long-term picture, really got crushed. And it came back toward the lows that it saw in the March 2020 COVID bottom. Now, look, I've put on a 2.5% weight in a macro portfolio. China is a lot more important than 2.5% in the world, but it's a tester. And we always talk about when we see change, we'll put on a small position and then see if it starts to work. And I think that there probably is a near-term opportunity here, but the risks remain. And so that's why the position will be sized accordingly.
Thank you so much, David. Well, that concludes the questions that we've received this afternoon. And as always, I will leave you with the final word, Dave.
Yeah, I saw somebody else putting up their hand. Jim raised his hand and he wanted to.
Okay.
I saw that he asked a question. What would we consider a high interest rate? And I think that we've answered that.
Right. Yes, we just answered that one.
And I think there was one more question that I saw. Re-government bonds, would that be SHY? Well, SHY is one ETF, which is short-term bonds. I think that if I were, looking at the health of the bond market in the US, I'm looking at TLH, which is the 10 to 20-year bond, which obviously had a horrible bear market. It's been through in two legs, one leg down, a consolidation, a second leg down. And probably we do a little bit of work here. So I don't know. I'm not interested in being in the bond market for the next period of time, as long as inflation continues to be sloppy. I think it's going to be a tough place to be. And if we're in a reflationary environment, I would far rather own dividend growth stocks. As we talked about the ETF FDL, frankly, our tactical income portfolio is built as it sits right now to be a dividend growth portfolio. And, versus a bear market and income securities has done remarkably well year to date.
Thank you,
I guess
Dave.
that's it.
I think so.
Everybody, thanks so much for joining in. Hopefully it was useful. We'll tune in again next week. Call will be at 4:00 next Tuesday, and hope everybody has a good week and enjoys a little bit of summer weather.
Thank you, David. Nice to see
Pamela.
you. Of course.